What if I told you there's an account where your money grows tax-free? You can pull from it tax-free. There's no limit on how much you can put in, and you don't have to be dead to use it. Sounds too good to be true, right? It's not. It's written into the tax code, Section 7702. It's been around for decades, and the wealthy have been using it the whole time. Today, I'm going to show you exactly how it works and why it might be the most important financial tool you've never heard of. Let me start with something that's going to bother you. If you own a home and you make extra payments on your mortgage every month, I need you to hear this. Paying down your house early only matters if you live. Let me say that again. It only matters if you live. Let's say you're putting an extra $200 a month toward the mortgage. In 2 years, that's $4,800 you gave to the bank. If you die in 2 years, your family still has the full balance. The bank has your $4,800 and your family has a problem. What did that extra money actually do for you? Nothing. It did nothing. But what if you took that same $200 a month and put it somewhere that could do 2 jobs? Job 1, if you die, the full mortgage gets paid off for your family. Job 2, if you live, which is the plan, that money grows over time, and eventually you have enough to pay off the house yourself. Or use it for retirement. Or use it for whatever you want. Same dollars, 2 jobs instead of 1. When you give that money to the bank, it only does 1 job, pay down interest. And if you die, it didn't even do that job well. So what is this account? It's called an Indexed Universal Life Policy. Some people call it an IUL. In our firm, we call it a tax-free retirement account because that's really what it is when you use it correctly. Here's how it's built. It's a life insurance policy at its core. That's the chassis. That chassis is what gives it the special tax treatment. The IRS says if it's structured as a life insurance policy and it follows the rules under Tax Code Section 7702, then the growth inside is tax-free and the money you take out is tax-free. That's not a loophole. It's not a hack. It's literally written into the tax code. Now, I know what you're thinking. If my money is in there, what's protecting it? Great question. Your principal is protected from market losses. Let me be clear about that. If the market drops 30%, your account doesn't drop 30%. It has a floor, usually 0, meaning the worst you can do in a bad year is nothing. You don't lose money. When the market goes up, you get to participate in a portion of the gains. There are caps and participation rates that vary by carrier, but the basic idea is this. You get some of the upside and none of the downside. That's the deal. So the way you earn is simple. The carrier tracks a market index, something like the S&P 500. When the index goes up, you get credited a percentage of that growth. When the index goes down, you get credited 0. Not negative, 0. Your money just sits there and waits for the next good year. Over time, this creates a steady growth pattern without the gut-wrenching drops that people in the stock market deal with. You're not in the market, you're just linked to it. There's a big difference. You can put money into this account on whatever schedule works for you, monthly, annually, whenever. And unlike a Roth IRA that caps you at $7,000 a year, or a 401k that caps you at $23,000, there is no contribution limit on this. None. You can fund it for 5 years and stop. You can fund it for 20 years and keep going. The more you put in, the faster the cash value grows. And it's entirely up to you how much and how long. That flexibility is something you don't get anywhere else. Now here's where it gets really interesting. As the cash value builds inside the policy, you can take money out. And the way you do it is through a policy loan. You're literally borrowing from yourself. Not from a bank, not from a lender, from your own account. No credit check, no application, no explaining to anybody why you need the money. You just take it. And the best part? It's up to you whether you want to pay it back. If you do, the money goes right back into your account and keeps growing. If you don't, it just comes off the death benefit. Your call. You're the bank now. So what would you use this money for? Whatever you want. Fund your kids' college without taking on student loan debt. Buy a car without making payments to a dealership. Make a down payment on a second home. Build an emergency fund that doesn't sit in a savings account earning 0.5%. Supplement your retirement income every single year tax-free. Or hey, pay off the mortgage. That was the original idea, right? The point is, this isn't money locked away until you die. This is money you can use while you're alive. And that's the part nobody tells you about. Let me just drill this home one more time because I don't think people understand how big this is. The money you earn inside this account is tax-free. The money you take out through policy loans is tax-free. It doesn't show up as income on your tax return. It doesn't affect your Social Security. It doesn't bump you into a higher Medicare bracket. The IRS can't touch it. In retirement, when every other account you have is getting taxed on the way out, this one isn't. That's not my opinion. That's the tax code. Section 7702. Look it up. Now here's where the strategy matters. There's a difference between a standard policy and what we call a max funded policy, and it's a big difference. A standard policy means you're paying the minimum premium needed to get the death benefit. That's fine. You get the mortgage protection, some cash value builds over time, but slowly. A max funded policy means you intentionally overfund it. You put in more than the minimum, and that extra money goes straight into the cash value where it grows tax-free. Think of it this way. Standard is like making the minimum payment on your house. Max funded is like paying extra. Except, unlike paying extra on a mortgage, this money works for you, not the bank. Let me give you a real example. Say you're 35 years old and you start putting $300 a month into a max funded policy. That's about what a lot of people are already throwing at their mortgage as extra payments. By the time you're 60, you could be looking at over $180,000 in tax-free cash value sitting in that account. And your family has had a $400,000 or $500,000 death benefit protecting them that entire 25 years. You didn't do anything different with your budget. You just redirected where those dollars went. Same money, completely different outcome. Now let's say you can swing a little more, $1,000 a month into a max funded policy, starting at 35. By 60, you could be sitting on $650,000 to $750,000 in tax-free cash value. That's retirement money. That's, I don't need my 401k money. That's, I'm going to pull $50,000 a year out of this account and the IRS can't say a word about it money. Meanwhile, your family had $1 million death benefit the entire time. $1 million of protection while you were building $700,000 in tax-free wealth. Show me another account that does both. I'll wait. And here's the beauty of the flexibility. You don't have to pay into this thing forever. Some people fund it aggressively for 7 to 10 years and then stop. The cash value keeps growing on its own at that point because you've already built the engine. Some people pay into it for 20 or 30 years because they want to maximize the cash value for retirement. Some people start small and increase later when their income goes up. There is no one right way to do it. You design it around your life, not the other way around. Now, I want to be real about something. This isn't just mortgage protection. When you set this up correctly, it becomes one of the most powerful retirement tools available. In retirement, you can pull tax-free income from this account every single year. And because it comes out as a policy loan, it's not taxable income. So let's say you're retired and you're pulling $40,000 a year from your 401k. The IRS takes their cut, maybe 22%, maybe 24%. You're netting $30,000. But if you pull $40,000 from your IUL, you get $40,000, all of it, because the IRS has no claim on it. That's a $10,000 a year difference, and it adds up fast. Now look, I'm going to be straight with you because that's what I do. I'm not here to tell you this is for everybody. It's not. This is built on a life insurance chassis, which means you have to qualify medically. If you've got major health issues, this route may not be for you. And there are other options I covered in my previous video that might be a better fit. That video is linked below. Age matters too. The younger you are when you start, the more time your cash value has to compound. If you're in your 30s or 40s, this is a no-brainer. If you're in your early 50s, it can still work, but the window is tighter. Once you get past 55, honestly, it gets harder. The older you get, the more the cost of the life insurance chassis eats into your cash value growth. And if you have any medical issues on top of that, it becomes even tougher to qualify. That doesn't mean it's impossible, but it means you need to talk to someone who knows what they're doing and can run your actual numbers. I tell people all the time, I'd rather be honest with you and lose the deal than sell you something that doesn't make sense. If this isn't right for your situation, I'll tell you. I'll probably recommend a term policy instead, which I covered in my other video. But if you're under 55, you're in decent health, and you want your money to do more than just sit in a bank account or get handed to the IRS, then this is worth a serious look. At minimum, it's worth a 15-minute conversation to see what the numbers look like for you specifically. Our firm is independent. We're not tied to any one carrier. We don't push products because someone told us to. We go out to the market, search across 65 to 70 carriers, and put together the best options for your specific situation. When we run your numbers, you're going to see exactly what your cash value looks like at year 10, year 20, year 30. You're going to see what you can borrow, when you can borrow it, and what happens to the death benefit. Everything in plain English, no jargon, no fine print tricks. So here's what I want you to do. If you're under 55, you're in reasonable health, and any part of this made you think, I didn't know that, then text the word book to 561-556-1970 to book a free call with us. We are nationally licensed and help clients across the country. We'll run your numbers. We'll show you what a max funded policy looks like for your age, your health, and your budget. And if it makes sense, great. If it doesn't, I'll tell you that too. No obligation, no pressure. That's how we operate. The consultation is free. The education is free. The only thing that costs money is doing nothing while the IRS takes a third of everything you've worked for. Think about that. I'll see you on the call.